Hello everyone and welcome to Chapter 5. This video will talk about the Chapter 5 concepts. We are going to begin with employer payroll taxes and labor planning. As you recall from the earlier chapters in payroll, there are taxes that the employee and the employer both pay, and there's also taxes that just the employer pay. This is a great chart to refer back to, which is on page 150 in your book. The employee, as you know, pays Social Security, Medicare, federal income tax, state income tax, if applicable, local income taxes, local occupational taxes, 401k pension, and any other voluntary deductions off their payroll check. Now, the employer, as you know, matches for the Social Security and Medicare. The employer now has to pay FUTA, which is federal unemployment tax, and SUTA, which is state unemployment tax, possible local occupational taxes, worker comp premiums, along with matching if it exists for 401k and pensions. As I mentioned before, this chart is located on page 150 in your book. Now, the employer's responsibilities, as you have learned in the earlier chapters in the payroll, they must match the amount of the employee deduction for Social Security. Now, keep in mind the employee has a 6.2% deduction, so the employer must pay the same amount. The base rate for Social Security, remember, this one does have a limit of $118,500. Medicare, both the employer and the employee pay, is at 1.45%, and they each pay the same amount. Now, if the employee earns over $200,000, the employee is only responsible for a 0.9% surcharge, and that the employer does not pay. And this is covered on page 151 in your book. Some examples of the employer's Social Security tax liability. As you know, you have to take the annual salary or how they're paid. In this case, it's biweekly. Her gross pay is $1,384.62. That times that by 6.2%, her employee share would be 85.85. The employer would pay the exact same amount because she's underneath that threshold of $85.85. So the total Social Security tax liability for this organization would be $171.70. Now, Medicare follows suit, but as you know, there is no limit on the Medicare tax. So both the employer and the employee will pay 1.45% on her bi-weekly payroll. So the Medicare tax liability in this example is $40.16. The total FICA responsibility from Courtney's pay this period, you would add Social Security and Medicare tax for $211.86. Now, FUTA and SUTA, federal and state unemployment taxes, which is covered on page 152 and 153 in your book. Federal unemployment tax pays for the administration expenses for the unemployment fund. State, which is also called SUTA, provides local unemployment fund resources within that state. FUTA is restricted to United States citizens and U.S. companies. Now, the FUTA rate is 6% on the first $7,000 of each employee's wage. That's the 2015 rate. FUTA taxable income is reduced by the employee's contributions to Section 125 plan, which was covered in Chapter 4. The employer is subject to 5.4% rate reduction, all right, if they make all the SUTA deposits in full and on time, so there's a little bit of an incentive there, and they are not in a credit reduction state. The SUTA rate, which is the state unemployment tax, does vary among state to state along with the companies that reside in it. For the problems for this chapter, they will give you the SUTA rate, so that does not have to be calculated. Some examples of how to calculate that. FUTA in this example here has 15 employees and they've earned at least $7,000 per year. Remember, $7,000 is the magic number that they have to pay unemployment taxes up to. So 15 employees times 7,000 times it by 0.006 is going to be $630. The SUTA, same thing, 50 employees times 7,000 times 0.054 is $56.70. So the total unemployment tax liability in this example for that company is $6,300. And this is covered on page 153 in your book. Also on page 154 in your book, it gives you the minimum and maximum rates on the SUTA wage base. Like I mentioned before, your problems for this chapter will give you the SUTA rate. Also in chapter 5, learning objective number 2 on page 156, there's 3 reporting periods that may exist. Employees can get paid monthly, semi-weekly, or the next business days. Depending on the size of the company's payroll, that will kind of dictate how frequent the company will report their deposits along with paying their taxes to the state. The IRS, in order to determine how the company will pay their employees and the taxes, will look at a look-back period. This is on page 156 in your book, which is the amount of payroll taxes an employer has reported in the 12-month period prior to June 30th from the previous year. Okay, and that's how they will determine when their deposits of payroll taxes will be determined. So based on, like I mentioned before, 12-month period prior to June 3rd. So the look back period for 2015 taxes was July 1st of 2013 through June 30th of 2014. Okay, so the amount of payroll taxes in the employee and the employer share determines the reporting period. Now, the reason being why it's July 1st through June 30th is because that is the fiscal year for governments. Their fiscal years begin on July 1st and their fiscal year ends on June 30th. So they are a little different than organizations. If an employee is reporting monthly income, let's say an example here, it's monthly $50,000 or less in payroll tax liability during the look back period, a new business are monthly scheduled deposits unless they are accrue in excess of $100,000 in payroll taxes for any period. If it's annually, it is due the 15th of the following month. Semi-weekly, if it's $50,000 or more in payroll tax liability, the payroll's on a Wednesday through Friday, it's due on that Wednesday. If the payroll's on Saturday through Tuesday, it's due on that Friday. The next business day, $100,000 or more in payroll tax liability is due the next business day. So just be aware that it is not the same for each payroll period. It just depends how the organization pays. All right, learning objective number 3, reporting mid-year and year-end employer tax reporting and deposits, Form 941, which is covered on page 156 through 159 in your book. Form 941 is the employer's quarterly federal tax return. It's used by most employers and is due by the 15th of the month following the end of a quarter. All right, so this is on page 158 in your book, and it's Form 941. As you notice, you're going to fill in the name of the person that's filling it out, the trade name, if any, the address. And then also what you're going to complete on line 2 is the total wages subject to federal income tax. That is on line 2. Line 3 is the amount of federal tax withheld from wages, tips, and other compensation, which you should be able to obtain from your payroll program. And then you're going to, in parts 5A through parts 5D, you're going to look at, okay, what did I have for taxable Social Security wages? Multiply that by 0.124. Also, if you had any Social Security tips, and then you would do 5C, taxable Medicare wages and tips would be the exact same amount. Multiply that by 0.29. Then what we're going to do is you're going to add those columns up, column 2, to get a total of $19,638.59 for letter 5E. Line 7 through 9 is your quarterly adjustments. So what that means is that if you add lines 3, 5E, and 5F, our total taxes before adjustments is $38,070.59. The quarterly adjustments for fractions of a cent, that is comparing what you had reported on your books, and in this case, it's a difference of 1 cent. So the total taxes after adjustments, you would add those. And then on line 11, that is the total deposits that the employer would make to the state for their taxes. On Schedule B, report the taxability for semi-weekly scheduled depositors accompanies Form 941, but it breaks down the tax liability by payroll date. And that is on page 161 in your book. So remember, this is for semi-weekly scheduled depositors. So same type of information, but in this case, we have to show our tax liability for month 1, month 2, and month 3. And we will be going through this in an exercise. Form 944, which is in your book on page 162. This is the employer's annual federal tax return who have less than $2,500 in annual tax liability. Okay, it's due by January 31st of the following year. Now, when state taxes apply, the firm must follow state tax returns. Okay, and this is on page 162 and 163 in your book. Like Form 941, the firm enters the details of all the wages paid along with computing the taxes that are due. So on Form 940, you're going to report the employer's annual federal unemployment tax. We're going to compute the use to compute future wages and tax liability, and it's due by the following year. And that's on Form 940. So a couple forms that are covered in this chapter. Form 941. You got Form 940, which is Form 941, Schedule B, and now we have Form 940, which is on page 165 in your book. This is the annual federal unemployment tax return. This is the FUTA. This is the actual FUTA return. And this is important that it is reported to the state because it is according to the IRS guidelines. So one thing to keep in mind, we have to look at the total payments for all of our employees, which is your total payroll, which is part 3. Then we're going to look at the amount payments made to each employee in excess of $7,000 to get a subtotal of our total taxable FUTA wages on line 7. Multiply line 7 times 0.006, and our FUTA tax in this example would be $504. So that would be our tax adjustment. W-2s is also covered in Chapter 5, which is on page 166 and page 167 in your book. As you know, we all get W-2s, which we report all the employees' pay during the year. It may not match the totals from the last pay of the year, depending on when the pay was issued. Now, one thing to keep in mind is that the taxable income and Social Security wages on the W-2 will not match due to the pre-tax deductions, which may reduce the taxable income. So we do need to take that into consideration. All right, so this is covered on page 167 in your book. So when you get your W-2, you have a copy A that goes to Social Security Administration to report how much Social Security you have paid in. Copy 1 of your W-2 is for your state, city, and local tax department. Copy B, that's where you file it with the employee's federal tax return when you get your taxes completed. Copy C is for the employee records. Copy number 2 is for the state or local tax department, and copy D is for the employer. So as you notice, when you do get your W-2s at the end of the year, there's quite a few different copies, and each copy does have a purpose. So if we look at the sample here, which is covered on page 168 in your book, box 1 contains the wages and tips and compensation. So in this case, Jill has earned $36,523.34. Box 2 is the federal tax withheld. Box 3 is her Social Security wages. These were the wages that were eligible for Social Security that were taxed upon. Box 4, as you can see, is the Social Security tax withheld. Box 5 is your Medicare wages and tips. And most of the time, these two do match, Social Security and Medicare. And then box 6 is your medical tax withheld. Also, sometimes on your W-2, as you can see in box 12, contains the amount for non